Good morning, ladies and gentlemen, and welcome to the KINOVO PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, as usual, we would just like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. I would now like to hand you over to the executive management team from KINOVO PLC. David, good morning, sir.
Good morning, and thank you for the introduction. Good morning, everybody. Thank you for taking the time out of your schedules to tune in to the full year results for the period ending 31st of March 2024. In terms of the agenda, we will skip through the financial highlights and the operational highlights for you. Alongside that, obviously give you an update on our discontinued operations in terms of DCB Kent. We'll then do a little bit more of a dive in terms of the financials, and alongside that, revert back to some of the initiatives and actions in terms of our growth strategy, namely accelerating our organic growth, expanding our core competencies, consolidating our geographic position, improving our collaborative support functions, and our investment in terms of our people and our communities. Following that, then I'll summarize with an outlook, and then we'll obviously give you the opportunity to go into Q&A within the presentation. So if we start off with the financial highlights with Clive.
Morning, everybody. Really just to give a flavor, we have a number of additional slides that we'll come to add a little bit more to it, but really just to highlight on our continuing operations, strong result from a profit perspective, up 20+% at most levels, and as we get further down the P&L, it's higher percentage with earnings per share up 37%. Revenues up 2%. We'll come back to that. We did exit from a private sector client, which was a strategic decision we made, which held back some growth, and there were some delays which we're expecting to flip over into the current financial year. Just held profit back a little bit, revenue back in the current year. Cash, another solid year in terms of cash, and we'll come back to that, but a very good cash generation and a good cash conversion percentage. And we ended up with a net cash position slightly down on the prior year. That's kind of driven really by the discontinued operations, which we'll again come back to. And what we are expecting is that we will be funding all the requirements that we have, and we'll go into more detail on that, from our existing facilities, which were actually renewed after the period end. So we have those in place to give us the firepower that we need going forward. Final point from me, really just on our visible revenues. It's a 3-year, starting from the 1st of April through the full financial periods, and we do that on a 3-year basis. It's not sort of into infinity, which other people will call it, and we have it as what we say as being visible. So it's our run rate, what's contracted, and what we have as an expectation over that 3-year period. That's up 11% at over 160 million, and that gives us good visibility in its name into the future trading of the business.
Moving on as we transition from the financial into the operational highlights. The continued execution of our strategy benefits from the legislative drivers and a streamlined focus on our 3 key pillars in terms of regulation, regeneration, and renewables. Regulation grew 9% and contributed to 60% of the total revenues, a little tick up from the 56% in previous year. Similarly with regeneration, that grew 10% and contributed 30% of total revenues, a tick up from the 28% from last year. And Clive alluded to this in terms of the revenue tick up. Renewables reduced 36% and contributed 10% of the revenues. 2 drivers on that really. One, as Clive alluded to, was the 3.6 million drop in revenues from the strategic exit of the private sector mechanical contract, and the other, which we alluded to during the year in terms of the lag on the renewables, was down to elements of planned works being delayed. And with respect to the planned works being delayed, this is where we've been provided awards through the Social Housing Decarbonisation Fund. Quite a heavy administrative burden with respect to that. But with that, like I said, in terms of the administrative burden, that has now been completed during the year, and we're starting to see some of the operational inputs now occur in FY25. I can go into more detail on that during the presentation. With respect to the gross margin increase and the EBITDA increase, driven primarily by a mix of works alongside continued operational efficiencies that we drive through the business, as well as our ongoing stringent cost management across the business. Coming back to the 3-year visible revenues that Clive alluded to, increase of 11% over the year. Our focus on diversification in terms of the client base provided an overall 11% net increase with respect to that, and is something that we're very much focused on. 99% of these visible revenues are recurring, and 69 million of these 3-year visible revenues are anticipated to be recognised in FY25.
Good morning, everyone. So if I continue on the operational highlights, we continued on that strategic investment to drive the implementation and capitalise on the market opportunities. And of those opportunities, that we strengthened the efficiency within our collaborative support functions, which did contribute to that overall margin improvement. We also established the retrofit team, which is fundamentally to focus on this government's decarbonisation objectives and into that social housing decarbonisation fund, specifically now with the Wave 3.1 funding that is coming, and bids are going in November. And we've carried on with that geographic consolidation of the new office in East Anglia, which has created a significant business opportunity and given us lots of short-term contract awards, and that's now converted into some longer-term contracts, which we'll share in the slides as we go through the deck. Business development continued, and that focus on the contracts at higher values, and that bore fruit with the award of an electrical contract with Hyde of 40 million over the next 8 years, and a 2-year contract extension in the mechanical division with Haringey. Frameworks also represented a significant growth driver, and that was evident in the Greener Future Partnerships, where we got a direct award of 4.8 million over 19 months, and the Eastern Procurement Asset Improvement Framework with an aggregate value of 156 million. So if I move very swiftly on to the DCB, and very pleased to say that the 9th project, which was at results stage principally signed, has been executed yesterday, and there was an RNS that went out this morning with those details. So really good news for us that final one is signed and sealed, and payment terms over that are spread over an 18-month period. So really now puts that legacy issue in the rearview mirror, leaving us just the one remaining project on site. So the other 7 are completed, of which is due to complete in July. So all on target for that, and full steam ahead now to look forward to the future and finally put the discontinued business behind us.
In terms of the financials on the DCB projects, I'll just cover it in 2 areas: the P&L impact and then the cash impact separately to that. They have slightly different profiles. In terms of the P&L impact, we've provided for a total of 12.9 million over the last 2 financial years. That is so that's cumulative. That includes the 2.2 million settlement that Lee referenced. And in terms of that agreed in principle that we announced last week and has now been completed, the commercial terms of that were absolutely in line with what we were expecting them to be. So that's fully provided. So in terms of P&L, we believe that is now fully provided for in terms of the cost elements. What is excluded from that is that we do believe that there are up to 2.6 million of potential recoveries that we could achieve. We haven't included those in the numbers, so there will be a benefit to the extent that they are realised in future periods when it comes back. And that's from an accounting perspective, it's a fairly high bar that we have to get to. So we actually have to have realised them to have reported them. So that's why they're not in that number and has inflated that number somewhat in terms of this reporting year. That up to 2.6 million is effectively in 3 different areas. We've had a number of variations on the project where we've done additional works beyond what was originally contracted. That's up to around about 1 million of the 2.6 million. And another about 600,000 is an extension of time, a loss and expense claim that we have on the project that actually is not yet finalised and completed. Completes at the end of this month. And that was there was an event that happened that extended the timeline of that contract. And we believe that there is a claim to be made, an extension of time opportunity. The final element, around about £1 million that we've got set aside in terms of an opportunity to recover some of the costs for what we know is the legacy poor workmanship that we previously reported on these projects and had pushed up the costs on them. So we think that there's an opportunity to recover some of those amounts against subcontractors. And that's probably a slightly longer term and a slightly more difficult process to go through. It's a lot more legally orientated, so it's difficult to know exactly the timeline on that. We will try to facilitate over a period of time. The other 2 areas that I mentioned previously, they have a sort of a timeline. It really is a final account reconciliations and settlements. Not in a normal circumstance, you'd expect those to have already been resolved as part of the process, but as people are aware, we inherited the legacy of these projects, and so in the past it's not always been completed to the process that should have happened. So we are now completing that process, having completed the projects to drive that forward. So in terms of timelines, it's a little bit difficult to really say exactly. The first 2 is a shorter timeline to the extent we can recover them. The subcontractor claims is a legal process to go through, so a little bit more difficult. But we have the opportunity there to bring that 12.9 million down. In terms of the cash flow, so effectively we'd paid out a cumulative of 9 million at the end of the financial year, but we paid a further 1.7 million basically at the end of Q1 of this financial year. So a total of 10.7 million, which effectively is the full amount of the 8 projects, with the outstanding amounts to go being around about 2.2 million to bring it up to the 12.9. Again, excluding any recoveries. So we're just putting those aside with those recoveries coming in as I explained previously. The 2.2 million, as Lee set out earlier, is effectively the settlement over an 18-month period on the final project. So we've got a profile there where we funded all of that 10.7 million from our existing facilities, and we're expecting that the amounts going forward will also be funded from our existing facilities, which, as I earlier stated, we actually have extended and renewed our facilities, and we have very strong underlying cash flow from our continuing operations. Back to the continuing business and the strength of our underlying and our future businesses that are going forward with the DCB projects principally now completed, subject to a tail of the cash flow over 18 months. So strong results, as I previously mentioned. Profits are up 22%, bottom line up 37% in terms of EPS and PBT. Revenues up 2%. What you'll see from there is that the real driver in the year has been the electrical division, up 14%, and that's been a very strong tailwind, and somewhat stronger than we probably expected it to be. Mechanical is down. That's the exit as we previously mentioned of the from us, the strategic exit from a private sector client has driven that down. And build services is up 4%, so a decent result. But what we're also seeing is a deferral into FY25 of some revenues. So we will see a mixed change going forward to where we're at from the real driver of electrical, which we still expect to happen, but just the mix to sort of rebalance a little bit. Underlying margin, very strong, again, driven by electrical. So that's really sort of driven our result this year ahead of expectations. So our original expectations were an EBITDA of 6.2. We delivered 6.7 in the end. So a really strong result against our expectations. Just in terms of tax, very quickly, there is a tax charge in there. It's lower than a standard UK tax charge at 15%. We had some additional tax losses brought forward, which brought the rate down. We do expect that to normalise to the underlying UK tax rate in years going forward. No tax payments in the year. We're not expecting payments in FY25 either, but we will start to resume into a corporation tax payment in FY26 on the back of FY25 results. And I think from a final perspective, we'll be starting to look, but not built into these numbers or forecasts at the moment, is in terms of dividend policy as and when the financial position allows it to be. Discontinued, I'm not really going to add very much because I think we've covered most of the elements in here, but you can kind of see the levels of loss that we've had to be absorbing on this. Fortunately, we are now coming out the other side of those and we can focus on the businesses going forward. But I don't think there's really anything to add, except I might just say what we hadn't previously mentioned is the settlement of that final project. There was a performance bond that was attached to that, the final one of 3 that we had as part of the legacy DCB projects, but that actually gets terminated as part of the settlement that we've just literally agreed. So that obviously finalises that overhang of that potential risk and liability that was there as well. Cash, solid cash. 88% cash conversion is actually slightly better than that. Actually, it's I'll rebalance 24 and 23. 23 had 107% cash conversion. Actually, that had, and we did talk about this last year. There was some cash that we received in advance last year of into the FY23 year, which actually related to FY24. So actually, if I rebalance that, FY23 was about 100% and FY24 would be about 94%. So really strong cash conversion, a factor and a structure of the continuing business that we have. Free cash, very strong. Low investment in capex, which is what we expect going forward, about sort of 0.3 million. And hopefully what we're seeing is that discontinued cash outflows. So will be finalised outside of the 2.2 million, obviously, that we've got from the settlement. Net debt, another very quick one from me, just to show the profile of where we've come from. And actually, if we've gone back, I think beyond March 20 into 19, I think we peaked at somewhere around about 14 million net debt, and there was actually a creditor stretch within that as well. So to have got that from there to a net position at the end of the financial year, FY24, I think just underpins and demonstrates the strength of that cash flow from the continuing business. And this reiterates it. A big green bar going up, which is the cash from the continuing business, and a big red bar going down, which is the cash outflow from DCB. Obviously, what we are aiming to achieve is the continuation of the green bar and the elimination ultimately of the red bar. There is obviously some cash flows still to go out in FY25.
So if we move on in terms of the growth strategy and providing some detail and flavour on that, clearly I reiterate that our number one objective is to accelerate organic growth. In terms of the evolution of the business over the last 4 years, we've seen a compound annual growth rate in terms of the revenue growth of our continuing operations of just under 18%. And then when we move across to EBITDA and the compound annual growth rate over the last 4 years of 47%, it is positive testament to the progression of the business despite the challenges of addressing the legacy issues put upon us. Just a reminder to the market and our investors in terms of the investment case within the business. If we look at this from the macro sector, we are in a long-term growth market. There is no question about that. There is a strong imbalance in terms of supply and demand, which requires growth to address this. If we go back to circa 1980, I think there were 5.5 million homes available in terms of the social housing sector. In 2022, this has dropped by 1.4 million. So the government has already said that they plan to make the biggest investment in terms of social housing, affordable housing for a generation. The homelessness in terms of social housing is well over 1 million. This requires growth to address that market, and we're clearly sitting bang smack in the middle of that. Within that housing sector, the UK does have the oldest housing stock in Europe, if not the world. And as a result, there is a continuous improvement to improve the energy efficiency of these properties, as well as the safety of these properties for the benefit of the residents. And with that, that's embraced within obviously the government's macro drivers. In terms of compliance, legislation, and decarbonisation, these two big drivers will persist with respect to the new government. They're overarching in the sector. They're not going away. If anything, they are strengthening. So that covers the sort of macro perspective in terms of the sector and the environment that we're working in. When you're drilling down then into the business itself, clearly our foundation of the business, as demonstrated by the 60% profile in terms of revenue from our regulation pillar, is the driver within our sector in terms of non-discretionary revenues, which are regulatory-led, compliance-driven, surrounded with that specialist service umbrella. We alluded to our visible revenues, and with that, obviously, that provides a predictability and strong visibility in terms of future earnings with long-term contracts and recurring revenues. And as Clive has already alluded to, in terms of the cash generation, robust cash generation, that is clearly transparent within this business, which moving forward will provide us with a breadth of capital allocation opportunities for the business. So that really provides that picture in terms of the progression of the business and the investment case relating to it. If we then dig into the business and that underlying performance overall, I've covered the elements in terms of the revenue split and the service divisions, which are highlighted in those two pie charts. Coming back to that renewable element, I think it's worth me sharing a little more detail when we said about the delayed planned works in terms of the renewables. And this relates to the SHDF funding. So in terms of the process that is undertaken there, we will, through that SHDF funding, will be allocated a property to provide a retrofit assessment on. So we will visit the property, and within the property, we will then provide an assessment of all the opportunities that could be undertaken to improve that energy efficiency rating up to an EPC C. We will provide this list then to the council that has specific energy rating scores next to each of these elements. The council will then apply the preferred list of options from that overall menu that they would like us to undertake. That comes back to us. We price that, provide a schedule of works. That goes back to the council. The council then applies for that funding piece, approves it, and then we get into the operational element of doing the work. There is a lag in that down to the administrative process per se, as explained. And that is the rationale for some of those delayed works. circa 4 million from last year. And like we said, that will start to demonstrate itself in terms of FY25. At the bottom is a number of elements there that just demonstrate the progression of the business, be it the cumulative cash that we've generated, that reversal of debt. As Clive said, when we stepped back into September 19, the executive team inherited a debt pile of 14 million and a 2 million creditor stretch, which we have progressed significantly through over the last few years. Similarly, underlying, we've seen that progression on EPS. So I think in terms of the take home from this organic growth perspective, we have made positive progress under pressure. We've strategically repositioned the business. We've concluded the legacies that we've inherited. We've managed the turmoil of COVID. We've financially restructured the business. We've cleared our historical debt, and our cash generation has continued to fund these challenges, as well as the ongoing continuing operations. So this is a positive perspective when we now look at moving forward with the business without the harness of any historicals and a pure focus on our future rather than our past. If we then move on in terms of expanding our core competencies, from an organizational perspective, we look at this core competency expansion both internally and externally, and we look at it directly and indirectly. And this starts with the team and our people. We have a positive culture in the business, and the execs are very proud to be part of a team that is driven by aspiration, driven by teamwork, and driven by a common sense of purpose. As we've gone through these challenges, there has been no element of complacency in the business. No matter how we progress, we continue to look for continuous improvement. And on behalf of the board, certainly, the recognition should go to the wider team for all their contributions in driving this forward. In terms of strategic partnership, there's two elements here. On the right-hand side is just examples of the accreditations that we have within our specialist services that we provide within the business, fundamental in terms of that qualitative perspective. And on the softer element, the list of affiliations that we are part of within the communities and society that we involve ourselves in. On the left-hand side, I want to allude to this because for some, this will be a tick box exercise. For us, this is part and parcel of our culture. Not only do we affiliate ourselves within these elements, we proactively participate within all of these as part of our sense of purpose and sense of commitment as a team. Our head of social value and marketing is a member on WISH, Women in Social Housing. She's on the board. Recently, there was the Pride event in London that we were pleased to be able to partake in and support. And then at the bottom, even when you look at that, Teens Unite, it's a cancer charity that we support. A couple members of our team recently took part in a Strictly Come Dancing ball, and the brave willingness to commit to raise money for charity by participating on that is admirable in terms of the team. So our strength of positioning is clear in terms of accreditations, affiliations. We do have the 3 strategic pillars, and we do promote a one-stop shop element within our focus, which provides that simplicity and clarity for our client base. In terms of clarity of focus, I've already covered the focus in terms of compliance and sustainability. I've listed a couple of examples here in terms of legislation drivers. The Social Housing Regulation Act came into play in July 23. An example of this within the Social Housing Regulation Act, fundamentally, it is there to provide greater power to tenants and residents against landlords. And the example I'll allude to is within clause 42. It's called AWAB's law, where there was the tragedy of that 2-year-old who died of respiratory issues due to damp and mold. Part and parcel within this act now is that if a tenant raises an issue relating to damp and mold within 14 days, the local council, local authority must provide a written report, having visited that site, and within 7 days of that, committed to some form of action. This drives a sense of urgency and accountability within that client base, which only feeds into the progression of works from our side as partners and supporters within that. Building Safety Act, again, we alluded to this previously. As of April the 1st now, the regulator of social housing does have HSE as its exam marker to ensure adherence in terms of that compliance process. And again, we're seeing that sense of urgency kick through in terms of that client base that we're attributed to it, and clients are starting to report themselves before they are reported, with a commitment that they will address this in short order. Finally, then on decarbonisation, again, we've talked about this previously. Leah alluded to the various waves that have come through in terms of the SHDF funding. And there's further waves to come in on that. So our strength of positioning, our clarity of focus, and the commitment of our team puts us in a good position to expand these core competencies. These core competencies, and moving forward, we will continue to build and broaden our network. You know, we are committed to continuing to diversify that client base and broaden that pie and broaden that opportunity. Continued diversification of our supply chain, and with that, continue the development of our people, so that we have this continued pipeline and we continue to drive that aspiration within the team and within the business. If we move on to the next driver, which is consolidate geographic position, I'll pass over to Lee to expand on this in more detail for you.
So I touched on this a little bit when we were talking about the operational highlights, and the Dereham office in the Norfolk region was officially opened in December last year. And as part of that opening, we had a number of smaller contracts, and we was almost put on a try as you buy type scenario by the Eastern Procurement, where lots of this work has come from. Originally, when the office was opened, and the guys talked earlier about the mechanical contract that we exited, the team from that contract were deployed to open and kick off that office. I'm pleased to say now that those guys have come back and are now back in the mainstream out of head office, and it's very much now a drive on local employment, geographically positioned staff that are local to that Dereham office. And of course, by being local, that then brings the efficiencies and allows us then to schedule those engineers and those managers, and gives you that productivity and that efficiency and that operational gearing of the teams up there. You know, it's evident now that since that December office opened and up to the end of FY24, we have since from FY25 onwards secured a number of longer term contracts. And if we look around on the slides, there's 5 contracts there that have been extended from a 2 to 3 month into a 1-year contract. And there's even the one on the right for Saffron, which is now over 3 years. So very much now this footprint in Norfolk is starting to bear fruit. The local employment is really kicking off. That's bringing in these efficiencies and the productivity. And lots of these contracts have been awarded via that asset improvement and sustainability framework via the Eastern Procurement. And you know, you'll see the value on there, which is an aggregate value over the 4 years. But again, I will reiterate what Clive and David have said earlier, that none of that framework value is in our visible revenues. There's no amount of framework in the visible revenues. So testament now to the pilot scheme is really starting to take off, and I look forward to adding some longer term contracts on top of these that we've got on the board there already. So if I look at what we've done from our collaborative support function, and this is very much a Amazon-esque type system called Find My Engineer. So fundamentally what that does, it sends a message out to all of the residents that have an appointment booked on that day, and they'll open up that message and they'll be able to see where the engineer is and what time he's going to be arriving at their property. It also allows them then to send a message back to us if they're not going to be in, and reschedule their appointment. So these SMS alerts have really added to that customer journey that we've got given to the residents. It's also improved our efficiency and productivity, and you'll see it's allowed us an 8% reduction in visits. It's given us a 41% reduction in access. And it's important to say, because if you look at the line graph on the right hand side, I think at the peak in January, before this was launched, we had 305 no accesses. Now, if I come down to when the slide graph goes up to in May, that's come down to the 115. So it's really evident in that reduction in no access. It's improved profitability by 13% and a massive 751% on a return investment. Now, this gives not just us clarity on our engineers, but it also allows the residents and the end customer to see where they are. Reducing carbon footprint and carbon emissions, which is also a really important part of what we do from the ESG and that carbon net zero perspective. The final part on that app is that it then allows a resident to look at a customer satisfaction report, and it's not got anybody there. It comes on the text. It allows them to do that once our operatives have left, and then that customer satisfaction information is fed then straight back into our system. A real improvement on the service that we're giving to the end users and the residents.
Just to add, in terms of Lee's comments, reference these profitability drivers, we reiterate that this started to get rolled out in February. The examples we give there is just one contract, but we're running it across the DLO, and it goes back to our drivers, not only in terms of driving the front end in terms of client base, but also looking at these small incremental improvements internally in terms of the operational efficiencies that will drive that margin improvement across the business as well.
And here's some further initiatives that are either in the process of being implemented or been implemented. I won't read through them all, but I'll pick a couple of elements out that I'll walk through. So if we look at the compliance module, I mean, that's a particularly good one for us because it's allowed the automation of the jobs. So engineer goes out and does a gas service. Once that gas service is completed, the job comes back down on his PDA. That's then completed on the system, and now the system would automatically schedule that new appointment in. If you tie that in with the SMS appointment, so the job is scheduled in, the SMS goes out, and now the resident knows when that next visit is coming. Takes out that manual intervention and allows us to fully focus on the important stuff in the system by automating that element. A really good one for us is this subcontractor portal. So subcontractors are fundamentally a bolt-on of our own internal DLO. They're treated in exactly the same way. So by them having access to our system, it allows us to really see when their appointments are booked in. It means that our customer service centre and our customer administrators don't need to phone these subcontractors up, find out where they are from an appointment perspective. This is all live and real-time information on our system. So what that does for us is it improves the order to cash cycle. And by that, I mean, the job's on there as a job. It's then sent out, the appointment's booked. It then comes back from the subcontractor, updates our system, and then allows the commercial team to see that that is a finished job. In will come the subcontractor's costs, taking away that delay in spreadsheets coming at month end and allowing that speed and transition from the subcontractor cost into our system. That then allows our commercial team to book that job in, put it on evaluation, and it will improve that order to cash cycle. So a real step forward from that visibility for us from the subcontractors into what we're doing. And then that really leads into the final one, which is the client portal. We run an open and trustworthy relationship and partnership with our clients. Our integrity is, you want to see our system, it's open doors. So it allows the end user and the client to really drill into what our KPIs are. It shows the performance dashboards, and it's really allowed that reduction in the administration related tasks. And this really is now all a part of adding to that improving customer journey, our ultimate client.
So if we move on now to investment in our people and our communities, I touched on this earlier, and I'll spend a short time on this, but the biggest challenge within the sector, regardless of company, etc., is labour and will be labour. Particularly if you look at the trade, the skilled workforce, there's an ageing workforce, and with that, there is a generational gap that is opening up with respect to that. We've alluded to the number of apprenticeships that we focused on historically, and we continue to focus on apprenticeships to drive that pipeline. 12% of our employees last year were apprentices, and we maintain that strength of focus to drive that apprenticeship perspective through. From a DLO perspective, as we've mentioned previously, we do have this hybrid model of subcontractors as well as DLO, and that provides us that flex as we grow, and we'll continue to maintain that flex and continue to diversify that subcontractor base as well as strengthening our own DLO. In terms of professional development, again, from our perspective, and I alluded to this earlier, there is a positive culture in the business, I believe, in terms of teamwork, purpose, aspiration, and we want to feed that, because if we feed that, the execution of the strategy will be fulfilled, and with that, obviously, growth in terms of our numbers will come naturally. 8% last year of our staff had some form of increased role and responsibility. The previous year was 9%, and we continue to create these opportunities through our growth path to allow the business and the team to progress as they wish in terms of their personal and professional development. With respect to investment in training, just under 4,000 hours across the piece with respect to that, and we will continue to invest in our staff. And I can only reiterate again our thanks to the team that we've got in place in terms of all of our subsidiaries for the commitment and resilience that they've demonstrated as we've continued to focus on our turnaround. Overall, in terms of numbers, staff numbers went up to 255 last year from 235 the year before, and we're creating opportunities within the local communities as well as internally as well. And then on the right hand side, educating the future, again trying to open up that pipeline of aspiration from school leavers, etc., whether it's taking part in terms of interview practice or whatever, but to give them an opportunity to realize that even if you want to step into business, there is an opportunity within the sector to facilitate and to do so. Moving then into investment in our communities, as we said earlier, part and parcel of the environment that we work in is a diverse one, and for us to be involved in that and to give something back to the communities only strengthens a sense of purpose within the organisation. From a simple thing to providing high-vis vests to a local primary school, through to, as I mentioned, attending Pride, through to helping out in the community kitchen, through to setting up a food bank with one of our housing associations. And the success of that food bank has been such that there are other housing associations now looking at how they can replicate that process within their own environments. And even down to that defibrillator donation. Within a week of that getting in place, that ended up saving someone's life in that community centre. So our work in our communities, our work with our people, are fundamentals for the future success of this business. And so we move on to the outlook. In terms of the business, I think it's clear, we have a robust, resilient business model. Our strategy is proving itself and delivering. We've achieved significant growth despite the operational and financial constraints of the DCB legacy, as well as the other legacy elements that we have inherited. We are now at an inflection point. And with this, our focus is solely on our future rather than our past. And we're very excited and motivated and committed in terms of now demonstrating the true value of this business without being unhindered, without being hindered by any of our historical issues. Strong visibility of future earnings. I reiterate 69 million of the 3-year biz revs anticipated to be recognised in FY25, 99% of these recurring. And as Lee alluded to, some positive successes now in terms of the conversion of these framework awards, but none of these framework awards are accounted for in our visible revenues. The only time they get accounted for is once we actually get a direct award from a framework. Within our business development team, we've made further investments in this. Last year we won, renewed or extended 13 contracts or framework agreements. Through that investment in the business development team, we have an external focus in terms of obviously new business, new clients, and we have an internal focus. One opportunity for improvement is cross-selling within the business. We have a lot of our clients have said in a previous client engagement survey that they weren't aware of the plethora of services that we offered and provided. And certainly this one-stop shop element is something that we are proactively working on internally through our investment process. And we expect again, with these framework awards coming in, to be announcing further direct awards within the year in relatively short order. The investment case is clear. We are in a long-term growth market. Social housing stock, UK housing stock per se, is the oldest in Europe, if not the world. That in its own right creates opportunities. And within that, the two drivers of compliance, legislation and decarbonisation is only strengthening and will only strengthen as we move forward. All of these create tailwind opportunities for the business. We're founded on non-discretionary regulatory-led revenues. We've got that strong predictability, visibility of future earnings, and the robust cash generation creates capital allocation opportunities for us as we move forward. In terms of where we sit and where we are, I reiterate the organic growth strategy, and over the next at least 12 to 18 months, the board is focused on a period of stability. Now that we're focused only on the future rather than the past, we want to demonstrate the true value and the true qualities of the business, being unhindered with anything in terms of the past, and with that, demonstrate what that can deliver without any constraints in terms of operationally and financially, and with that as well, demonstrate the strength of our cash generation as we look to build cash reserves on our balance sheet over that time frame. So with respect to M&A, there is no foreseeable M&A for us because one, the organic growth strategy creates enough potential and opportunity in our own right. Two, we want this period of stability. And three, with that period of stability, demonstrate the true underlying opportunities in terms of the business and the strength of our cash generation. And as a board and as a business, we are confident that we will continue to deliver a consistent, continuous, sustainable path of growth moving forward. Thank you very much. That concludes the crux of the presentation, and we'll move over into Q&A.
Perfect. David, Lee, Clive, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company takes a few moments to review those questions that were submitted already, I would just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. David, Clive, Lee, we obviously received a number of pre-submitted questions ahead of today's event, and as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this morning as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And guys, at this point, if I may just hand back to you to read questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you. So moving across to the Q&A, first question that we've got on the list here says, great results, David and the team. Thank you. With DCB liabilities finalised, I'm expecting a flurry of bids from interested parties, including private equity. Any thought as to what market cap you can get KINOVO to if we stay independent? Our focus on the business is to drive this business forward. Do we have a limit? Do we have a where we can get to? Well, from our perspective, sky's the limit, because we're now fully focused on the future, and with that, look to just drive this organic growth moving forward. So that we have nothing in mind. Our focus now, as I've already alluded to, is to focus on now unleashing the business and driving that growth strategy and executing it well. So there is no limit in terms of where we have with respect to that. With respect to valuations and so on, we've seen a number of independent research come out with what their perspective is in terms of where the share price is or should be from a realistic perspective, and we can only allude to those rather than our own. But numerous of those have come out as a baseline of 150, 160 to where we should be now as we stand. And from our perspective, then, like I said, that's the independent view rather than our own. Our sole focus really is to just drive the operations of this business and to execute the strategy as best as we can. In terms of the second question, what does the disposal of DCB actually look like, especially in terms of finances? In other words, what is coming back to the kitty and how and when? Hopefully, Clive has covered that during the presentation, so we won't reiterate that. But if there's any sort of extensions of that question, by all means, please feel free to submit those. To what extent are the trial contracts in the Norfolk region coming through to larger contracts? Again, Lee has alluded to the evolutionary process from the try before you buy to now the shortage contracts to some longer contracts, and we expect that to continue to evolve. I think the beauty of that is you're seeing the execution of direct awards through the framework agreements, and with that, an ongoing diversification of that client base. So that test pilot in terms of that geographic consolidation is starting to demonstrate itself. REDCB in July 2023, estimated cost to complete were 4.3, then in November 23, 5.7, and then in Feb 24, 7.1, and finally July large rise in 12.9. Why have these costs been so continually underestimated? Why have they occurred? And why are the anticipated recoveries only 2.6 when there was a rise of 3.58 in costs from Feb 24 to July 24, which was stated due to poor workmanship, etc.? Clive?
Yeah, that's a big question, actually, isn't it? I mean, I'm not sure how long that might take, but let me really summarize it down anyway. So we did in February, I think it was, we had a similar presentation to this one in terms of the big uplift in costs that we were seeing coming through on those projects. And in summary, a lot of remedial costs were required relating to legacy poor workmanship that really only became apparent right at the end of the projects. Boilers not connected correctly, drainage not correctly done, sort of groundwork levels not completed properly. And that was really the big driver in terms of where we were moving from original expectations. There was some uplifts as we went through, but bearing in mind that what we inherited here were some half-built projects that we had a responsibility to take on and complete, and that drove up the costs as we saw them. In terms of where we've moved from, from February to now, we have previously referenced that we expect there to be a number of recoveries. In those numbers that we previously referred to, those were netted down within that number, because that's an overall expectation that we had, and we've referenced that in terms of the 2.6 million that we're estimating that we have as an opportunity. And then the balance of the movement is coming really, I think, from that final account settlement that we're going right back to the beginning of the presentation virtually in terms of the final project, which although it's more than we had provided for previously, I think it actually gives us a complete finalization of that project. It was a project that potentially had a 2-year runway to completion, and the risks and time and focus that would have impacted upon. So we had a financial settlement arranged around that, which effectively draws a line under that project, which would have hung over us for quite some time. So that drove that up, and obviously what we are still now playing for is the recovery of as the maximum amount of costs that we possibly can.
The only thing I will add to Clive's answer is specifically in terms of that poor workmanship statement and the rise of costs. In terms of the claims, clearly when we relate to that poor workmanship, the expectation or the potential for claims is and should be much higher. But unfortunately, with the structure of some of these subcontractors, a number of them have already gone bust. Trying to be realistic in terms of that expectation of return is part and parcel of what we've worked into the provisions for. Next question is, as you mentioned, you had a favourable mix in terms of gross margins. How do you expect this to change in FY25? What gross margin can we expect in the long term?
Yeah, to me, yeah. I mean, absolutely. I mean, we had a 3% increase in gross margin in the year, driven effectively on the back of those real tailwinds that we saw on electrical. We are expecting that to rebalance, not necessarily the individual margins in the individual sectors, but certainly in the mix. So we are expecting that to go back a percentage point or so. What we are seeing as well, though, is and forecasting is double-digit top line growth. So this is some of the things that we've alluded to in terms of the delays that are coming into FY25 in terms of revenue pushing that up. But then that margin impact is just rebalancing, which brings us, I think, EBITDA margin was 10.5% in FY24. We'll probably dip just below the 10%, but still fairly robust margins overall in terms of the business.
Next question is, what is the board doing to eliminate the deficit on reserves against share premium so that dividends can be paid sooner? I can only reiterate our focus here in terms of the business now to have a period of stability, and with that to maximize the growth drivers that sit behind the strategy and to continue that execution of those to drive that profitability through the business, which by default will have an impact in terms of the distributable reserves. Alongside that, obviously, that period of stability will allow us, as I've already alluded, to build the strength of cash reserves on the balance sheet so that we can assess, evaluate our capital allocation opportunities moving forward. Dividends are clearly one, share buybacks are another, and during this time frame, we will continue to have a proactive dialogue with all our shareholders to assess the preferred direction of travel, alongside firming up then what we will actually do moving forward in terms of that capital allocation process and policy. This then moves into the next question. Are you going to want to raise funds for the business? Again, I can only reiterate exactly what we said, and as we sit, we see no need to raise funds for the business, and from that, we want to increase that value per share, and driving that value per share is fundamentally driven by that profitability basis and to put cash on the balance sheet, and with that, allow that natural progression of the business to allow the paper to catch up in terms of the potential value versus where we currently sit. So to answer that question, are we going to want to raise funds for the business? We don't foresee that, no. Where will the next new depot be after Dereham? I think the number one focus again rather than get too excited and too carried away, is get Durham bedded down within that geographic regional coverage. There is obviously next door neighbours within that area from a geographical perspective that we are starting to cover through some of the work that were undertaken in Durham anyway. So the simplistic thought process is that we'll build from Durham, but the number one thing is let's get Durham motoring and really prove that pilot case, and during that time frame will give us an opportunity to evaluate where we go next in terms of the next new depot.
What I would add on that, David, is the Durham office was obviously born from the opportunity that come from that Eastern Procurement Framework win. And there is still ample opportunity within the London and the South East region, which is our core business area, to really drive that organic growth. So it's just another point on one.
Thank you, Nick. Next question. Gentlemen, congratulations on the great fiscal year and getting rid of DCB. Thank you. Could you please elaborate on the following two questions? Number one, how did you end up with 2.2 to terminate the final project? And number two, could you share some thoughts on how investors should think about your current and future gross margins? In previous calls, you stated that 29% is more or less exceptional. I think Clive did cover that second question to a certain extent. Anything else to cover on that, Clive?
No, I don't think so.
Covered that.
Yeah.
Hopefully that answers that question. And coming back to how did you end up with 2.2 to terminate the final project? Lee, perhaps you want to get into detail on that?
Yeah. I mean, fundamentally, it was in protracted negotiations. There was over a long period of time. I mean, we've been talking probably over the last 18 months to nearly 2 years about getting this Bensham Lane project closed off and bottomed out. Our actual or ultimate liability on that was around about 4.1, 4.2. So that's part of that protracted negotiations, and it was agreed that we would settle on that 2.2 with the structure of the 18-month payment terms, which allows us as a business to fundamentally fund that from our ongoing cash generation.
I mean, I think just to elaborate on Lee's comment there on the 4.2, if we went back to the original heads of terms that we proposed, this was a halfway house perspective in terms of the heads of terms, that we would share the costs with the respective client, which gives you that circa 2.2 million type number. Within that, were we to have built this out, and bear in mind these discussions go back a good couple of years, but were we to build that out, we would have looked at and had assessed value engineering opportunities, which would have brought that 2.2 backwards to the provision that we put into the accounts of circa 0.9. So without that opportunity to implement these value engineering opportunities, we're back to the original 2.2. But like I said, that is half of the original liability anyway. And within that, obviously, the opportunity for having definitiveness, decisiveness, and an end was for us then a necessity in terms of getting that closed out. Next question here is, please expand on your capital allocation opportunities, slide 20, which opportunities you are looking to prioritize. So number one, again, just to reiterate, and apologies for doing so, is to have that period of stability to build those cash reserves and demonstrate the true deliverable of this business in terms of where we're at. From that, as I've already alluded to, we will look at both share buybacks and a potential dividend policy as two capital allocation drivers that we'll assess moving forward. With respect to M&A, as I said, there is nothing in the sight line in terms of M&A, because the prospects for organic growth are so significant. We'd like to focus on that, which in turn I think will reflect positively with regards to the valuation of the business through that demonstration of that organic growth strategy. If we are to look at M&A, I've come back to why would we do M&A? Well, the number one challenge, as I've already reiterated, is labour in the market, and therefore an ongoing deep dive in terms of our subcontractor base would probably be the sort of nearest assessment process for us from an M&A potential. The reason being, and the challenges in terms of M&A, obviously, is the number one cultural fit and what is required with respect to that. And of course, it comes with risk. Now, if we're evaluating that subcontractor base, we've tried before you buy, so we have an assessment of that. We can capitalise on that labour front end and redeploy that to maximise the efficiency. We can take out the back end. With that, we can take out a margin, and with that, then there's potential for additional revenues as well, all within an element of a box risk scenario. So with where we're sitting, focus on driving the business, build the cash reserves. Within the cash reserves, we'll assess the share buybacks as well as dividends in terms of that allocation policy, and moving forward well downstream. If we were to look at that, the probably first step is to look at our current resource base rather than go into market. But we will not veer from our strategic pillars and our 3 service divisions. We want to focus on our strengths and build and deepen those rather than broaden those out. Next question is, can you give an approximate potential value on bids, tenders submitted and awaiting results? Lee?
Yeah. Very short answer, really. As at the back end of last week, I think we had 17 bids that were awaiting decision, spread across each of the service divisions, and that amounted to around about circa 41 million pounds of revenue that was attributed to those 17 that we was awaiting decisions on.
And obviously, this is an ongoing process where, to Lee's comment today is already out of date because we're continuing to progress within that process. Next question, can we expect the administrative expenses in FY25 to be in a similar range for FY24?
I think similar range, certainly similar to what you kind of expect. There certainly will be an uplift. I mean, it's driven. Staff costs are a significant element to that, and we continue to want to invest as well in the underlying business and particularly in the staff to drive some of those opportunities and prepare for some of those future opportunities as well. So I think it will definitely go up. I'm not expecting it to be sort of significantly ahead of any kind of expectations in terms of top line or bottom line growth, but probably kind of in line.
Next question, when do you expect to start paying dividends and what will they look like? I think I've covered that on several occasions, so hopefully that answer is clear. Next question, congrats on a terrific year. Can you give us a flavour of the competitive dynamics you're seeing? Given your strong performance, are we right to assume that you've been increasing market share? First and foremost, obviously the market is vast. So in terms of progress, the market is growing whilst we are growing as well. So it's difficult to pinpoint in terms of specifics on market share, depending on sector, depending on service, etc. But overall, in terms of the sort of competitive dynamics you're seeing, certainly from our perspective, and obviously we're focused on our outlook, the awareness of the business is increasing. The recognition of the business is increasing. Our relationships are not only strengthening, it's evident that we're broadening our client base. And from a competitive dynamic perspective, from all the feedback that I've just explained, and the positioning that we are, we are making good progress, and we are being increasingly competitive in terms of the recognition of who we are, the one-stop shop offering, the 3 strategic pillars, and the focus in terms of our compliance and decarbonisation. In the long term, could you see the option of retaining profits and using 100% of them for M&A and refraining from paying a dividend? Long and short, in terms of using 100% of them for M&A, again, hopefully I covered that in the number of questions that I've answered previously. Our focus is, at this stage, is very much on an organic growth strategy, and the outlook from where we can see will be maintaining that. Clearly within that, there is, if we're taking that organic growth approach, there will be a build-up of cash within the business. And that's not to say, as I've already alluded to, that we won't undertake M&A, but the focus is this organic growth strategy. And therefore, with this build-up of cash, clearly there will be an expectation of a return from our shareholders. The number one thing will obviously for the share price to catch up with where it currently is and where it could be, should be. And then in terms of paying a dividend or share buybacks, we will, of course, be looking to maximize returns for our shareholders, taking all those into consideration. Next question, what percentage of bids do you win roughly? Dave?
I mean, if I look at it now, it's currently about 1 in 3, so every 33%, but obviously that will include some of the framework awards and then the direct awards off of the back of that. So it's roughly about 34% of bids that we undertake.
Seeing what else there is here. That seems to be it that we can see from questions that are available.
Perfect.
I think that was it.
David, Clively, if I may just jump back in there, thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But David, perhaps before really just looking now to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yeah, thank you very much indeed. In essence, just to summarize, as I stated in our outlook, the business, I'm pleased to say, is at an inflection point. And it is an inflection point where we have dealt with the legacies of the past and are solely focused on our future. With respect to our staff and our employees, I want to reiterate my thanks for their commitment, their support, their teamwork, and their resilience as we manage some of the operational financial constraints to move the business forward and deliver the sort of results that we delivered under those constraints. So I want to thank them. And similarly, I want to thank our shareholders. There is a vast number of shareholders actually that have been here before us in terms of the initial challenges, should we say, that unfolded, that we stepped in to inherit. And I detailed the number of challenges we've faced as we've continued this transitioning process to deal with the past to get to this inflection point. And on behalf of the board, I would like to thank the shareholders that have been in there just both before our time, but during our time as well, for your patience and again, your support as we've made this transitioning point. And you can be assured that as a board, we are committed as ever to ensure that your patience will be rewarded with respect to the business, its outlook and its deliverables. So thank you very much indeed for your patience and support as we've ridden through this. If there are any other questions, as always, please feel free to reach out to us directly, and we'll endeavour to answer these for you if they were not covered within the time frame that we've had. Thank you all very much for dialing in, and thank you all very much for your time.
David, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KINOVO PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.